This is an image of a Zimbabwean dollar. And yes, it does say $100 trillion. Back in 2009, when hyperinflation hit its peak, this amount of money could probably buy you a loaf of bread. This is an example of hyperinflation, but an extreme one. Our focus today, however, is on North America and inflation, which is nowhere as extreme or as stubborn, but certainly something that deserves our attention. As the Russia-Ukraine war began in February of 2022, the prices of commodities and the international economic equilibrium received an unwelcome shock. In the months that followed, economic growth was downgraded, and the general price level of goods, especially essential goods, skyrocketed. It's been a steady decline since then, but certain indicators suggest that inflation might be on its way back up. What are these signs? What does the Federal Reserve have in store to bring down the rate of inflation to its desired target? We'll explore this and more. Follow along as we proceed step by step to probe the inflation that has been plaguing the U.S. for more than a year now. Chapter 1. Inflation figures and what they mean. As we said in our intro earlier, the rate of inflation has shot up due to the Russia-Ukraine war, especially the cost of food and oil driving up the prices. It's been reported that the oil prices have increased by 12% in just a month. This chart shows us what wild ride inflation has seen in the U.S. From hitting its peak of 9.06% in June of 2022, it started declining. This was widely seen as a result of interest rate hikes that were activated by the Federal Reserve and a gradual smoothening of the international economic operations post-war. Through the months of 2023, we've seen a gradual decline, except for last month, August 2023. If we take a look at that chart, the inflation rate rose from 3.2% to 3.7% from July to August of 2023. This increase has been the highest since July of 2022. The inflation rate, or the Consumer Price Index, also known as CPI, measures the rise in prices of specific products that are given weights according to the data collected by the Consumer Expenditure Survey. Sources say that this has been driven largely by high rent and fuel costs. Fuel prices rose, and the housing market is showing no signs of slowing down either. The Housing Cost Index also rose for the 40th month in a row. Paradoxically, however, core inflation, which does not consider food and energy prices, basically excluding volatile items, also rose by 0.3%. Don't you think this is strange? So probably the impact of fuel and food costs is not as huge as we initially thought. When these figures of the rise in inflation rate were reported, it set off a frenzy of points and counterpoints debating the next action of the Federal Reserve. Jerome Powell, the chair, has not made it any secret of his organization's desire to curb inflation by hiking interest rates. If you've seen our earlier videos on the U.S. economy, you would have heard us mention that the Federal Reserve has increased the rate 11 times since March 2022. The recent Fed Reserve, or the Fed Open Market Committee meeting held on the 19th to 20th of September 2023, has kept the rates unchanged. Let's take a back seat and take a closer look at its outcomes and what Jerome Powell had to say. While you do that, why don't you pause the video and hit that like button? Your support is an indication of your appreciation of our content. Chapter 2. The FOMC Dilemma. Increase or stay put? After the recent inflation increase, some predicted that the Fed may hike rates again. Reports by the BBC suggested that experts said that the Fed would be left questioning whether their pace of the rate hikes is achieving the desired outcome. So basically, suggesting that a rate hike is on the way. The Fed, however, has decided to stay put. The current interest rates, therefore, remain in the 5.25 to 5.5% band, as was arrived at the last meeting of the committee. Why did they do that? We would imagine that they would be inclined to increase their rates, given the recent rise in prices. Bond yields have also risen due to the current rise in the rate of inflation. Jerome Powell contended that the current continuing growth in the economy was something that he had not foreseen. A soft landing is a practice used by central banks to raise interest rates enough to cool down and prevent an economy from overheating and leading to extreme cases like Zimbabwe. The Fed would be looking to achieve that seamlessly, but troubled waters lie ahead. The next meeting is set to take place on October 1st. Do you believe that they'll increase their rates or stay put? We have our answer in the next chapter. Stay with us as we deliberate upon the future actions of the FOMC. Chapter 3. What does the future look like? The decision taken by the FOMC to keep the interest rate unchanged was an indication that the Fed might be nearing the end of raising its benchmark rate. However, reports suggest that we may still see a rate hike in the FOMC meeting next month from October 30th to November 1st. The central bank wants to keep inflation at its desired range of 2%, projecting that they may be able to achieve this only by 2026. In a nutshell, the Federal Reserve has kept or maintained its hawkish stance. Jerome Powell was quoted saying that people are definitely not a fan of inflation. He also went on to say that economic growth and job creation have been on the up. This has been unexpected, and he hopes that the interest rates would cool down an overheated economy and landed softly. The interest rate, even if it remains unchanged or decreases next year, will continue to have an effect if we consider the inflation-adjusted real interest rates. Jerome Powell hopes that the rate hikes, intended to increase the cost of borrowing funds, will keep demand and business expansion muted, achieving the goal of letting the economy cool down without having an adverse effect. The individual consumer is facing the brunt of this continued high inflation rate. As the value of money goes down, the purchasing power of consumers goes down as well. Just last month in August, the total credit card debt of Americans touched a record $1 trillion. As inflation continues to remain in play, fears and uncertainty of debt repayment are not unfounded. In addition to credit card debt, student loans are also going to mount up. Do you remember the forbearance period applied during the pandemic that gave a respite to students? Well, now, the forbearance period is coming to an end, and regular interest payments are going to resume from the 1st of October. It can lead to a blooming of debt, and with the Fed signaling there may be more interest rate increases in the future, one must tread carefully if they are a debtor. Although it usually is not something that gets corrected in the short term, workers may demand higher wages to compensate for the loss of the value of their income and adjust it to inflation. Would this not work counter to the Fed's fight against inflation? In some ways, yes. Companies may want to adjust this rising labor cost by increasing the cost of their goods or services, essentially passing it off to consumers. This might work against the Fed's efforts to achieve a soft landing. The U.S. economy is in uncharted waters. It was projected to grow at 1% in real GDP terms, but recent data suggests that the growth has been pegged at 2.1%. The growth estimates for the next year have also been revised upward to 1.5%. The world is watching with bated breath what steps the Federal Reserve will take. In a similar vein, the European Central Bank hiked its interest rates to 4%, the highest since the establishment of the euro. Inflation is taxation without legislation. These words said by the renowned late economist Milton Friedman correctly capture how we feel about inflation. As the Fed continues its fight against inflation and aims to achieve a goal of a soft landing to avoid the economy from slipping into a recession, we will also continue to monitor the situation meticulously. If you enjoyed our deep dive into inflation, we would love it if you could subscribe and hit that like button to show your support. It indicates to the YouTube algorithm to push our video to more screens. Now, if you're feeling generous, please hit that bell icon so you don't miss out on any of our future uploads.